Hey future homeowners, I'm John Werner with Mortgage and Credit Pro, where we make home buying simple, clear, and focused on your long-term goals. Today we're talking about something that almost every home buyer runs into, but a few fully understand: PMI, or private mortgage insurance. And let me tell you, understanding PMI could save you thousands of dollars over the life of your loan. So whether you're getting ready to buy your first home or thinking about refinancing, let's break this down so you're prepared. Let's start with the basics. What is PMI? PMI is insurance that protects the lender, not you. When your down payment is less than 20% of the home's value, it's a monthly fee that gets added to your mortgage payment until you build up enough equity in your home. Now, PMI isn't bad. In fact, it's the reason many people can buy a home without waiting years to save up 20%. But knowing which loan program you're using and how PMI works within that loan is key. Let's talk FHA loans first. FHA loans are backed by the Federal Housing Administration and are designed to help buyers with lower credit scores and smaller down payments. With an FHA loan, the minimum down payment is 3.5%. In some cases, you are also able to get down payment assistance to cover the 3.5%. In this case, you would not need a down payment. You'll pay upfront mortgage insurance premium of 1 3/4 of the loan amount. This is usually rolled into the loan. Then you'll pay a monthly mortgage insurance, MIP, based on your loan amount, down payment, and loan term. Now here's the part most people don't realize. If you put down less than 10%, that monthly MIP stays for the life of the loan. If you put down 10% or more, it lasts for 11 years. So unless you're refinancing to a conventional loan, later FHA mortgage insurance doesn't go away. Now let's talk conventional loans. With a conventional loan, mortgage PMI is a bit more flexible. You can put as little as 3% down. The cost of PMI is based on the credit score and down payment. And most important, you can get rid of it. Here's how it works. Once you reach 20% equity in your home, meaning your loan is only 80% of the home's value, you can request to remove PMI. Once your loan has hit 22% equity automatically through your regular payments, your lender must remove it. No request needed. Also, PMI on conventional loans is cheaper for buyers with higher credit scores. If your credit score is mid-700s or higher, PMI could be less than $100 per month, way less than FHA in some cases. But if your score is lower, PMI on a conventional loan could actually be more expensive than an FHA. That's why working with a mortgage expert who compares both options is so important. So how do you avoid PMI completely? Simply putting 20% down. But let's be real, not everyone can do that, and that's okay. In most cases, PMI is a small price to pay to get into a home sooner than later. You can also look into lender paid PMI, where the lender covers it in exchange for a slightly higher rate, or refinancing later once you have enough equity. Here's what I want you to remember. PMI isn't something to be scared of. It's a tool, and if you understand how it works, you can use it to your advantage and make smarter decisions about your home loan. If you want help figuring out the best loan and PMI option for your budget, credit score, and goals, that's where I come in. Let's find the plan that makes the most sense for you. If you don't already have a great real estate agent, let me know. I work with great agents who understand how to structure offers with your mortgage goals in mind. If this video helped you, please give it a thumbs up, subscribe to the channel, and share it with someone you know who's thinking about buying a home. I'm John Werner with Mortgage and Credit Pro, and I'll see you in the next video.